Hello, welcome back, everybody. My name is Tim Kelly. I'm the author of Get Your Financial Foundation Established. Why don't you? We are here to talk about something that scares a lot of people, something that a lot of people are uneducated about. And bottom line, there's no financial education in our society. There's no financial literacy across our nation. It's terrible. I hate it, and I want to change it. So I'm here to share some very simple and actionable steps about something that a lot of people don't know about, but we all have to understand because we all use credit, your credit score, what your credit score is, and the 5 things that impact your credit score. All right, I'm going to keep it short. I'm going to keep it sweet. I'm going to keep it very basic and very simple. All right, your credit score. Most people know what your credit score is and how important it is to keep it up. It's a number between the range of 300 and 850. People use that to understand what your credit worthiness is. They judge you on your credit score because that is an indication of your credit worthiness, how likely you are to repay those debts. All right, whether it's a bank, a financial institution, some kind of lender, they will evaluate your credit score, and that will dictate your interest rate and how much they will lend to you. And this is also important for employers and property managers when you're trying to rent a place and you're trying to get into an apartment, or if you're trying to get a job. Everybody nowadays looks at your credit score. So let's take action. Let's take responsibility and get that credit score up. All right, the goal here is to get it above 800. All right, that is the goal. If you're above 720, that is really good. You will get the pretty much the best rates on almost every kind of lending, any type of lending. If you're above 760, you will get the best rates on any kind of loan, or any kind of money, regardless. Okay, but our goal is to get above 800. So we know what a credit score is. We know what it makes up. Let's talk about the 5 things that impact it. Short and sweet. Number one thing, it's as you may already know, on-time payments. Make your payments on time. All right. It's never been easier with technology to either set up an automatic payment or remind you to make a payment, whether you're borrowing money for a car loan or a mortgage or something like that, anything related to it, or a utility bill or a phone bill. Make your payments on time. Do not miss any payments. All right. Second thing, credit utilization, credit to debt ratio. This is something a lot of people don't understand. It's very simple. This is the total credit limit that you have given to you. How much of that are you using? Okay? If you have a credit card that is $1,000 limit and you're using 800 of it or 900 of it revolving every single month, that is 80 to 90% utilization. The goal is to get under 20%, no more than 30%. You want to get under 20% and stay under 20%. If you're still using that $800 or $900, what if you had a credit limit of $10,000? I know it might scare some people, but that means your credit utilization would be under 10%. All right. The goal here is to get as high of a limit as human possible and keep the utilization under 20%. Okay. So that's where you need an American Express, a Visa, a Discover, and a MasterCard. All 4 major credit cards from 4 different financial institutions, and get as high of a limit as possible with as low of an interest rate as possible. For the interest rate, we never want to pay interest rates. How do you do that? You make you pay the statement balance off in full every single month. All right, that's an indication. If you can do that, that you are living well beyond your means, and you really need to evaluate your expenses and cut down on your spending. Okay, we don't want to live a lifestyle of scarcity. We want the abundance lifestyle. What the goal here is to increase your means and expand your means, not constrict your means, but you need to live within your means before we can expand your means and you can live an abundant life. Okay, so get all 4 credit cards open, as high of a limit as possible, lowest interest rate as possible. Never pay the minimum payment. Always pay the statement balance off in full every single month. All right. Number 1, on-time payments. Number 2, credit card utilization or credit to debt ratio. Keep it under 20% of your total credit limit given to you. Number 3, the third thing that impacts your score is Length of credit history. All right. Don't close accounts. If you've had account, especially if they're over 5, 6, 7 years old, those are your best friends and the most that will impact your score because they've been open for so long. Only if they're in good standing. Make sure they're in good standing. Make sure you have as high of a limit as possible if they're credit card accounts and the lowest interest rate as possible. Keep them open. It's not hurting you to keep them open. Every year you may have to use it to keep it active. Otherwise, that lender or that credit the financial institution may threaten to close it if you're not using it. Keep it active if you have to, but keep it open. Length of credit history has a 15% impact on your score. All right. So 1, on-time payments. That's 35% of your score. 2, credit card utilization or debt to income or credit to debt ratio. 30% of your score. The third one, length of credit history. 15% of your total FICO score, your total credit score. Fourth, types of credit used. This is 10% of your score. What type of credit are you taking? Usually it's narrowed down to installment loans or some kind of revolving credit line. Installment loans, you make the same amount of payment every month. Mortgages, auto loans, personal loans, that is the same payment every single month. Those actually have more of an impact on your total score. The other kind, revolving, it just depends on how much you use. Like credit cards, you use X amount, you got to pay that same amount back that within that same month, or they'll charge you extra interest. And interest rates on credit cards are ridiculous. Usually it's about 17% right now is the going average for credit cards. That's crazy. Number 5, new credit. What kind of new credit are you asking for, and how often are you asking for it? The soft inquiries and the hard inquiries. What's the difference? Usually a soft inquiry is just when creditors or lenders or financial institutions are evaluating you for your credit worthiness or checking out your credit score. That is a soft inquiry. That's not anything that will impair or negatively impact your credit score. Hard pull is something when they're actually pulling your score and then move forward and borrow you money and lend you that money. That will impact your score, okay? But then now you have a credit card open with that respected financial institution. So that has a 10%. New credit has a 10% impact. So again, to review, try to get up to 800 credit score. All right, that's the whole goal here. Everybody knows what a credit score is, how important it is in our society today, and how easy it is to maintain it with these simple steps that I'm giving you. Number 1, on-time payments, 35% of your score. Number 2, credit utilization or your credit to debt ratio, that is 30% of your score. Number 3, length of credit history, 15%. 4, types of credit used, 10%. And 5, new credit, 10%. Thank you for listening. Again, my name is Tim Kelly. I'm the author of Get Your Financial Foundation Established, Why Don't You? Reach out to me. Love to chat with you. I'll help you out in any way I can. I will talk to you guys later. Tim Kelly out.